Hey everyone, at this point, you've probably already heard why everyone is talking about Apple stock, the massive over $100 billion share buyback program, of course, right? That's the big headline. But what gave management confidence to initiate that kind of plan? Why did it initiate that plan instead of reinvesting in the business? That's more what I want to talk about here. Of course, I'll talk about that big headline, but we'll build up to it by looking at the lead up to that announcement. So let's take a look. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now. Right, so Apple's product revenue in the latest quarter was down 10% year over year, $67 billion in revenue product. And, it has a product segment and a services segment. The product segment is much larger. The services segment is more profitable, as I'll share with you in a little bit. The company says it had a challenging comparison from the same time last year because it had an unusually large sales in the iPhone segment. Okay, we'll give you that. But what was key is that the installed base of active devices reached an all-time high across all products and all geographical segments. This means the installed base, the number of people that are right now using iPhones, iPads, MacBook Airs, Apple computers, etc. The number of those, the sheer size, magnitude is in the billions now, over 1 billion. And that gives Apple the confidence to do certain things that it may not otherwise have done. Let's go on. So the company overall, its gross profit margin was 46.6% overall. But the product's gross profit margin was 36.6%, whereas the services gross profit margin was 74.6%. That's an incredibly lucrative business model where you could sell these products at premium prices that generate gross profit margins over 36%. And at the same time, those products lead customers into your ecosystem where you generate gross profit margins over 74%. Apple's business is essentially Tesla's dream. That's what Tesla is, dreaming about one day becoming like Apple. Tesla is trying to sell cars, which are its products, so that it could then sell services, the full self-driving, driverless rides, upgrades, etc., right? And that's where, the services segment is where Tesla wants to generate those very high profit margins. That's where it's pointing investors to look at, don't look at our gross profit margin now. Look at what our gross profit margin could be 10 years later when we have driverless car technology and we're selling all of these upgrades and services into the vehicles and generating strong profit margins from those services sales. Apple already does that, and it does that with a gross profit margin of over 36%. Tesla would dream of having a gross profit margin over 36%. It would dream of that. Its gross profit margin is about half of that and going down quickly. And the services segment is nowhere near the size of Apple's services segment. So this is that lucrative business model that some of these hardware/software companies or product/service companies try to implement because it's so lucrative. You get people in with your hardware, whatever it might be, whether it be a phone, a car, a Roku player. There's several of these types of business models. It's very lucrative when you get it at scale. Apple's net income in the latest quarter, $24 billion. That annualizes close to $100 billion, especially when you consider the seasonality in the business. It's on pace over $100 billion in profit. Operating cash flow, $23 billion, right? Again, annualized approaching $100 billion or above. That's where Apple is getting the confidence now, that strong, the foundation of the business that's generating this much profit with this kind of competitive advantage to protect itself with this type of split between profitability. It feels like we can feel confident in giving back $100 billion to shareholders through buybacks, because we know we're going to generate that much this year. So we can go ahead and we are already investing significant sums in research and development. So it's not like we need more money to invest in research and development. We're already doing that. So we've got more than enough money to use internally. And so we don't want to just let this money sit around in the bank, not earning. Let's give it back to shareholders. Let them decide what to do with their money. And I think that's a good decision. And it reduces the company's assets, which lowers the burden on the business. If you have $100 billion in assets, you now need to generate $50 billion to have a 50% return on assets. If you lower your assets by 20 billion, you now only have to generate 40 billion in order to generate 50% in return on assets. So as a company, you only want to retain assets that are going to generate profit for your business. Of course, you hold some cash for emergency, for potential acquisitions, for potential big opportunities, but you don't want to hold excess cash. That's beyond what you feel you can reasonably use. You want to return that to shareholders. So management saying that a survey from Kantar said that iPhone was the top-selling model in the US, in urban China, in Australia, in the UK, France, Germany, and Japan. And the satisfaction rate is at 99% in the US. The thing just works, right? If you've had an iPhone, it might not have the latest and greatest technology among all of the phones out there, but in terms of reliability, it just works. The thing just works, which is what you need from your everyday smartphone. You need the thing to work. So Apple also saying that paid accounts are growing double digits year over year, and paid subscriptions showed strong double-digit growth. They now have over 1 billion paid subscriptions across the services on our platform, more than double the number that we had only 4 years ago. And remember, subscriptions are recurring revenue. Every month, people pay that subscription, and that when you already have the customer and they're buying a subscription and you've already paid for the rights for that service, whatever those rights might be, whether it's Apple TV or Apple Music or Apple News or the storage, that's very profitable, and you can understand why those profit margins are so high in the services segment. All right, I said we would build up to the share buyback, and we're almost there. The company ended the quarter with $162 billion in cash and marketable securities, even after repaying $3.2 billion in debt. They now have total debt of $105 billion. So they have $162 billion in cash and marketable securities and $105 billion in debt. So Apple has said they want to be at a net cash position, a neutral position, meaning the same amount of cash as debt. So if that were to be the case, they would need $105 billion in cash and $105 billion in debt, and that would be a net neutral position. So during the quarter, they returned over $27 billion to shareholders through dividends and buybacks already. And so because of that massive cash hoard and their goal to reduce their cash in relation to the debt, you can understand why they authorized an additional $110 billion of share repurchases, and that's part of their goal of getting to net cash neutral over time. So, of course, that's what the big headline was coming out of the shareholder meeting, was that big share repurchase program. That's what got investors excited and sent the stock price higher by 6%. And I hope this gave a little bit more insight leading up to why management made that decision. Before I let you go, let me tell you about the greatest deal on YouTube. With just a click of a button, you can get free financial analysis from a professor with decades of investing experience. So what are you waiting for? Hit that subscribe button, and I'll see you again soon.